Hello and welcome to the College Investor Audio Show. We're so happy you're hanging out with us today. Thanks so much for being here. As we take a look at this article, how employers can contribute $2,500 to Trump accounts. We've heard about them. Let's dive into them. And by the way, anytime you hear a podcast, you can always find the article with it at thecollegeinvestor.com, where you can dive into all the links and the resources that are there, ask questions, do whatever you want, leave a comment on the article. You can also do the same thing on social media. Probably a better contact there if you want to make contact with us. Type in the words The College Investor. You'll find us pretty much anywhere you are. We're there too. All right, let's dive in here. Employer contributions to Trump accounts are now legal. 1 year to the day after the OBBBA created the new children's savings accounts. For small business owners, the launch opens a question worth real money. Can your business fund your own kids' accounts with pre-tax dollars? Great question, and the answer appears to be yes for many owners, but the mechanics do matter here. The tax break runs through new Internal Revenue Code Section 128, which lets an employer contribute up to $2,500 per year to the Trump account of an employee or an employee's dependent without the amount counting as taxable income to the employee. For a solopreneur, who is also an employee of their own company, me, that can mean a business deduction on one side and no income tax on the other, a combination that's really hard to find elsewhere in the code. But the provision comes with paperwork requirements, contribution caps, and also several unresolved questions the IRS has not yet answered. So here's what the rules require, where the opportunity sits for owner-operators, and the mistakes that could undo the benefit altogether. All right, here's how the employer contribution works. Trump accounts, created under Tax Code Section 530A, are a special type of traditional IRA for children under 18 who have a Social Security number. A parent or guardian opens the account by filing Form 4547 or using the government's online application at trumpaccounts.gov, and the funds must be invested in low-cost mutual funds or ETFs that track the S&P 500 or maybe some other index made up primarily of U.S. equities. Money cannot be withdrawn until January 1st of the year the child turns 18, at which point the account converts to standard traditional IRA treatment. Total contributions from all sources are capped at $5,000 per year, indexed for inflation, of course. According to IRS guidance in Notice 2025-68, that's a mouthful, children born between January 1st of 25 and December 31st of 28 also receive a one-time $1,000 federal pilot program contribution, which doesn't actually count against the cap. The employer piece sits inside that framework. Under Section 128, an employer may contribute up to $2,500 per year, also indexed after 2027, to the Trump account of an employee or the employee's dependent. Two details matter here. Number one, the $2,500 limit applies per employee, not per child. So an employee with 3 kids still is like $2,500 in total employer money. Number two, the employer contribution counts against the $5,000 aggregate cap per child, so a family planning to contribute on its own needs to coordinate the two. The contribution is excluded from the employee's gross income and, according to an analysis by Grant Thornton's Washington National Tax Office, is a deductible business expense for the employer. Draft IRS forms show the amounts reported on the W-2 in Box 12 under new code TA. Here's what businesses must do to qualify. The income exclusion only applies if contributions are made under a Trump Account Contribution Program, or a TACP, a separate written plan the statute requires to exist for the exclusive benefit of employees. Section 128 borrows most of its program rules from the Dependent Care Assistance Program, DCAP, requirements under Section 129D, including this: non-discrimination. The program cannot favor highly compensated employees or their dependents in eligibility or benefits. So, if you have a team, you cannot quietly set up a program that covers only your own kids. Notice, employees must receive reasonable notification that the program exists and what its terms are. Annual statements is the third thing. By January 31st, every year, employees must receive a written statement showing what the employer contributed for the prior year. One notable difference from DCAPs, Section 128 cross-references paragraphs 2, 3, 6, 7, and 8 of Section 129D. I know, too many numbers, but anyway. But not paragraph 4, the rule that limits owners holding more than 5% of a business to 25% of total DCAP benefits. That may have been confusing. Please reference this article, by the way, at thecollegeinvestor.com. Some of the stuff is kind of confusing, so you have to dive into all of the different links and resources right inside the article. Okay, back to it. The owner concentration test is what makes dependent care FSAs nearly useless for owner-heavy small businesses like solopreneurs, like myself, for instance. Its absence from Section 128 is a meaningful opening for small firms, though there are some attorneys that note that regulations addressing non-discrimination testing are still coming, and the proposed regulations issued in March of 26 reserved the employer program sections for future guidance. There's also some good news on the compliance front. On June 17th of this year, the Department of Labor issued Technical Release 2026-02, you don't need to know the number, taking the position that Trump accounts and TACPs generally are not ERISA pension plans when they benefit employees' dependents. Programs that contribute to a teenage employee's own account can also avoid ERISA or ERISA, provided participation is voluntary, the employer stays out of investment decisions, and the employer does not hold the program out as an employee benefit plan. Okay, let's take a look at those mistakes that we need to avoid with all this stuff. A few mistakes could turn the benefit into a problem, really. Do not skip the written plan document, the employee notice, or the January 31st statement. Without a qualifying TACP, the exclusion does not apply. Do not exceed the caps. Obviously, overcontribution to IRAs generally trigger a 6% excise tax, and the $2,500 employer amount counts towards the child's $5,000 total. If both parents, employers, offer contributions, just know that the IRS has not yet clarified how the limits coordinate, so just tread carefully here. Do not assume payroll tax treatment. Guidance to date addresses the income tax exclusion, and employers should confirm FICA handling with their payroll provider or CPA. And remember, the back end. Employer contributions come out as ordinary income when the child eventually withdraws them, which makes the account a tax deferral play, not a Roth. One way around this is to eventually convert the Trump account to a Roth. That also takes some planning, though. Okay, so small business owners, here's what this means for you, like C-Corp businesses, for instance. This could be a new possible way to save for your family tax deferred. An S-Corp owner who pays themselves a salary is an employee of the corporation, which means the business can adopt a TACP and contribute $2,500 per year toward their owner's dependent children, deductible to the business, income tax-free to the owner, with no other employees. There is no one the program could discriminate against, similar to the logic behind solo 401k plans. Owners should still document the written plan and confirm the approach with a tax pro, since the IRS has not issued final non-discrimination rules. Sole proprietors and partners without W-2 wages are in murkier territory here. The DCAP or DCAP statute explicitly treats self-employed individuals as employees for program purposes, while Section 128 contains no parallel provision. Until the IRS says otherwise, an unincorporated solopreneur should not assume they can pay themselves an employer contribution. So that's speaking directly to people like me. And if you're like a gig economy worker, you too. A few other angles worth noting. A business that employs the owner's spouse as a bona fide employee could contribute toward the couple's children as the spouse's dependents. And a business that legitimately employs the owner's teenager can contribute $2,500 directly to that teen employee's own Trump account, though Not really through salary reduction or under a cafeteria plan, which is only permitted for contributions to a dependents account. For hiring, the benefit also works as a recruiting tool. A $2,500 pre-tax family benefit can stand out for small employers competing for parents in the workforce. That is our show for today. Yeah, I know. In a podcast form, this one is a little more confusing because there's a ton of numbers and rules and all the different things. So please find this article at thecollegeinvestor.com because this is very, very important stuff to know if you have kids and you want to contribute to these things. We've heard about the Trump accounts. Dive in deeper right on the website. Also, ask us as many questions as you want. We will point you in the right direction for your family. Just type in the words The College Investor. You'll find us pretty much anywhere you are on social media. Thanks so much for stopping by today, and we'll talk to you again real soon.